Joining me now for a closer look at what's playing itself out in that market scene is Cobus Potgieter from Southern Cross Capital. Cobus, always a pleasure and a good afternoon.
Good afternoon, Alexander. It's been a while.
It really has been a minute. Pleased to have you with us this afternoon, Cobus. Not a bad showing for now, coming out of Europe, South Africa as well. But let's talk about, maybe the past 4 days, it's been quite a roller coaster there. Some days red and literally some days green.
Yes. Look, everybody's an expert on coalition politics at the moment, so I'll spare you my opinion on that. But I suppose the truth is that that is the narrative which has been largely sort of pushing markets locally, particularly the bonds and the currency, but to a lesser extent equities as well. Today's bullish situation comes down to the expectation for a start in the rate cutting cycle. So obviously, of 55 economists surveyed, we've got 53 calling for a 25 basis point cut this afternoon at 2:15 from the ECB. And the other interesting one is the Bank of Canada cutting rates yesterday. That is the first cut we've seen from a G7 nation, and I think that's obviously quite a bullish signal from the market's perspective. Yes, it's a reasonably small economy. Europe is a reasonably large economy, and even if it's just sort of the inflation outlook and the inflation experience of those two markets, ultimately the world is intertwined. And what this does is it makes that interest rate differential between the US and those nations widen, which increases the US's purchasing power, which over time drops their inflation, which over time allows them to cut their own interest rates. So altogether, quite bullish for that call, and the market is now really starting to price in with a high degree of certainty the idea of a US rate cut by September of this year.
Wonderful, Cobus. What I do know, though, is the fact that over maybe the last few months, the markets have gone ahead in terms of the US, and we've always then had to come back, peel back our expectations. Are we being a little bit more careful this time? Because, of course, even though all of these moves with the EU and Canada may lead to accelerated rate cuts in the US, the Fed may still be more hawkish.
Yes, and I must say that the sort of effect I've described would take a long time, and that would be very disappointing to the markets if that were ultimately the reason we started seeing rate cuts 12 to 24 months from now. So that's not quite what we are getting at. I suppose that it's more of a we're starting to see real evidence of the cutting cycle turning. At the previous juncture, the market was trying to anticipate, and in terms of current pricing, that higher for longer is still in the price, frankly. So even though we are pricing cuts, it's far less aggressively priced than it was before. 10-year US yields went to 3% at some stage in anticipation of the rate cutting cycle commencing. They are still well in excess of 4% at the moment. So, which, just for context, that's sort of dire straits territory still. So, no, the market certainly isn't looking for four rate cuts this year still, as it was perhaps 12 months ago. But certainly much more measured, but starting to see very real evidence of the cycle turning. Even though the green shoots from that will take as long as the hiking cycle took to start imposing itself and bring inflation down.
I also want to just touch on our own local inflation picture here, because, of course, we're trying to figure out our politics. I know you don't want to speak about it, but how can we not? Where the rand is sitting, where it's sitting, Cobus, and it's very possible that as the rest of the world might go into a cutting cycle, we may have some domestic factors that really hold us back.
Yes, absolutely. And let's be frank. The reason our monetary policy, one of the reasons our monetary policy has been so effective, number one is credibility, and number two is the rand. We control inflation very effectively by controlling interest rates. That's just plays out in the markets, plays out in the flows. It's called the carry trade, or a very liquid market, and it's sort of the developed world's favorite carry traders. Go long ZAR, you'll pick up that nice 4% interest rate differential, which reflects both purchasing power parity and a country risk premium. At the moment, that country risk premium is expanding because there is that uncertainty in the markets. And ultimately, if we sit at this level, the rand, the worst performing emerging market currency in the world this week, because of this uncertainty. The market prefers bad news to uncertainty. And if this persists for a long time, or we have what the market doesn't like, which is what's currently sort of being proposed, the government of national unity, which is without a dominant majority seat holder like the ANC was in 94, a government of national unity ends up being quite unstable and leads to new governments very quickly and sort of call it policy constipation. That is going to that's going to be seen as a negative outcome, and ultimately the Reserve Bank will have to react and up rates and to try and control that inflation as the weak ZAR pushes through into higher inflation. So, and that could constrain us still further. But ultimately, that's the mandate they have, is to try and contain inflation. So in a world where inflation seems to become more benign, the weak currency, which is quite isolated to South Africa at the moment, might push us over the edge, and we won't enjoy those same rate cuts in tandem with the US as we did through the previous cutting cycle.
With that said, Cobus, let's look at counters that you like. And the reason I'm asking is because it's just such a quiet one, right, on all markets, on the JSE specifically. But do you have a stock pick this afternoon?
My stock pick is Naspers, which is quite a boring one typically, but a couple of reasons for that. Obviously, the majority of the assets, more than 100% of the NAV still, is reflected in that Tencent holding in Hong Kong. So, in tandem with other South African stocks in the wake of this uncertainty, Naspers has been under the cosh. It's felt a bit of pressure, but it is typically a rand hedge stock. Obviously, it holds these offshore assets that are priced in hard currency, and it's lagging those assets on a constant currency basis. So it's quite cheap. We just on a fundamental level as well, the discount is wider than it's been in about 8 months, mostly driven by this local sell-off we've seen. But also, Tencent has come off its lofty highs. It is still very cheap. And in the medium term, a turn in the rate cycle in the developed world tends to be very good for Chinese equities. And given that Tencent is a very attractive tech stock, which is very well priced at the moment at a forward PE of less than 17. I think this presents a very nice entry point into Naspers. And at some stage, either the currency corrects or Naspers reflects the fact that their hard currency assets are worth more than they were a week ago in ZAR. And you should pick up from that benefit in the short term. And in the medium term, we really like the underlying assets and that exposure to China.
Wonderful, Cobus. So always a pleasure talking to you. Thank you so much for your time this afternoon. That was your midday markets update with Southern Cross Capital's Cobus Potgieter.